Hey, what's up? Welcome back. So real quick, close your eyes for a second. When I say market crash, what do you picture? Probably red numbers everywhere, right? Maybe traders freaking out on the floor of the NYSE, lines outside banks, your retirement account getting cut in half overnight. That's what we've been trained to expect. That's what happened in 2000. That's what happened in 2008. But here's what I want you to sit with today. What if the next collapse doesn't look like that at all? What if it doesn't show up on your brokerage app? What if the stock market keeps going up and you're still getting poorer? Because that's exactly what I think is happening right now. And by the end of this video, you're going to see it too. Over the last 25 years, we've had 3 massive financial crises, and every single time, here's what happened. The damage didn't get cleaned up. It got moved, like when you shove stuff under your bed instead of actually tidying your room. It looks fine from the outside, but the mess is still there, and it's getting bigger. I call this the 4-floor framework, and understanding it, genuinely understanding it, could be the difference between your retirement being fine and your retirement being a disaster. So let's get into it. All right, floor 1. The year is 1999. The internet is new, it's exciting, and everybody is throwing money at tech companies. Doesn't matter if those companies have never made a single dollar of profit. Pets.com? Sure. Webvan? Absolutely. Just throw a .com on the end of your name and suddenly you're worth billions. The NASDAQ, which is basically the home of tech stocks, went up 86% in 1999 alone. That's not growth, that's a mania. And then it popped. Between 2000 and 2002, the NASDAQ crashed 77%. 77%. Trillions of dollars in startup capital just gone, wiped out. Average retail investors, people like your parents maybe, lost half their retirement savings. Now here's the key question, and I want you to really think about this. Where did all that money go? Because money doesn't just disappear. It's like energy. It has to go somewhere. And what happened next tells us everything about the system we're living inside. The Federal Reserve, led by Alan Greenspan at the time, cut interest rates aggressively. We're talking rates going from 6.5% all the way down to 1% by 2003. The idea was simple: make borrowing cheap, stimulate the economy, ease the pain. And it worked, kind of. The immediate recession softened. But here's the thing. That cheap money didn't go back into tech. Tech was burned. Nobody wanted tech. Instead, all those cheap loans flowed straight into real estate. Home buyers, developers, banks, everyone piled in. And just like that, the risk didn't disappear. It just moved up 1 floor. So welcome to floor 2, the mid-2000s housing boom. Now, low interest rates were only part of what built this floor. In 2004, the SEC, that's the Securities and Exchange Commission, the main Wall Street regulator, quietly allowed major investment banks to increase their leverage ratios to 30-1. Think about what that means. For every single dollar they actually held, they could borrow and bet $30. 30. That's not investing. That's gambling with borrowed money at a scale that's hard to even wrap your head around. And what were they betting on? Mortgages. Specifically, subprime mortgages. Loans given to people who, honestly, probably couldn't afford them. But Wall Street didn't care because they'd figured out this trick of bundling those risky loans together into these complex securities, mortgage-backed securities, CDOs, all of that, and selling them off to investors around the world as if they were safe. Now, to be fair, and I want to give you both sides here, some economists argue the 2008 crash wasn't really a monetary policy failure. The Center for American Progress makes a strong case that deregulation of private financial institutions was the real villain, and that's not wrong. Both things were true. Cheap money and reckless deregulation created a perfect storm. Either way, when the housing market started cracking in 2007, the whole thing buckled fast. Bear Stearns collapsed in March 2008. Then in September 2008, Lehman Brothers, a 158-year-old institution, filed for the largest bankruptcy in U.S. history. The entire global banking system froze overnight. And what happened? The government stepped in. Treasury Secretary Henry Paulson got Congress to pass the $700 billion TARP bailout. The government literally purchased the bad assets from failing banks and injected cash to keep them alive. What that means in plain English is this: the banks made the bad bets, and the taxpayer picked up the tab. The risk moved off Wall Street's books and onto the government's books. Up to floor 3. And this is where things get really serious. Fast forward to early 2020. A global pandemic shuts down the entire world economy in a matter of weeks. Supply chains freeze, businesses close, unemployment spikes, and here's the problem. The federal government is already carrying the massive debt load from the 2008 bailouts. It doesn't have a clean balance sheet to work with. It's already in debt. So what does the Federal Reserve do? It goes into emergency overdrive. The Fed's balance sheet, which is basically a measure of how much money the Fed has pumped into the financial system, expanded from $4.3 trillion to $7.2 trillion in just a few months. To put that in context, it took the Fed over 100 years to accumulate the first $1 trillion. They added nearly $3 trillion in about 12 weeks. And it wasn't just the US. Every major central bank in the world did the same thing simultaneously. The ECB, the Bank of Japan, the Bank of England, all printing, all stimulating, all at once. That's important because it means this is not a uniquely American problem. This is a global sovereign level event. Now, here's the counter argument, and it's worth hearing. PIMCO, one of the biggest bond investors in the world, argues the Fed has pulled back since then. They've been doing quantitative tightening, basically shrinking the balance sheet, and markets haven't collapsed. So the Fed isn't totally out of tools. Fair point. But here's the problem with that argument. The American Action Forum's balance sheet tracker shows the Fed's total assets are still sitting at around $6.7 trillion as of June 2026. Despite all that tightening, the bulk of the 2020 intervention is still stuck on the sovereign balance sheet. They trimmed around the edges. The core debt load is still there, and so the risk has climbed to the highest floor available, the fourth floor. Okay, this is the big one. This is what I really want you to understand. Floor 4 is different from the first 3 floors in one critical way. There is no floor 5. There is no entity on Earth with a big enough balance sheet to bail out the US Federal Reserve. The IMF can't do it. The UN can't do it. Nobody can. When the risk hits the currency itself, there's nowhere left to push it. So what does that actually look like in practice? First, let's look at the numbers. As of June 3rd, 2026, total US national debt is $39.2 trillion. The Senate's own Joint Economic Committee tracker shows it's growing at roughly $8 billion per day. Congressional Budget Office projections, cited by bond legend Bill Gross, show U.S. public debt rising from 101% of GDP in 2026 to 120% of GDP by 2036. And Gross, who is known as the Bond King, this is a guy who ran the world's largest bond fund, uses the phrase hegemonic decay to describe what's happening. That's not a phrase you use lightly. And here's the data point that I think is the most important headline of 2026 that nobody is talking about enough. On June 2nd of this year, the European Central Bank, not some fringe gold bug on YouTube, the European Central Bank, released a report showing that gold has overtaken US Treasuries as the world's top reserve asset. Gold is now at 27% of global central bank reserves. US Treasuries have fallen to 22%. Read that again. The asset that has been the bedrock of the global financial system since World War II, the US Treasury bond, just got dethroned. And it's not just gold prices moving. Look at what's happening to sovereign bond yields. The 10-year yield is going up in the US. It's going up in the UK. It's going up in Germany. It's going up in Japan. It's going up in Canada, all at the same time. When yields go up across every major economy simultaneously, that's the market sending a very loud message. We are losing confidence in government debt everywhere. Meanwhile, and this one really gets me, the US personal savings rate has dropped to just 2.6% as of April 2026. The long-term average is 8.37%. So at the exact moment that the sovereign level is under stress, the average American has almost no financial cushion. There's no buffer at the consumer level either. Now, here's the counter-argument I want to address honestly, because it's a real one. The Committee for a Responsible Federal Budget points out that because the US dollar is the world's dominant reserve currency, a severe currency crisis is actually less likely here than it would be in, say, Argentina or Turkey. Foreign demand for dollars gives the US a unique shock absorber that other countries don't have. That's true, and it matters. But, and this is the key, but it doesn't mean it can't happen. It means it happens slower. The dollar's reserve status buys time. It doesn't buy immunity. And here's the thing, the crash is already happening. You just can't see it if you're using the wrong measuring stick. This is the chart I want you to stare at for a second. The blue line is the S&P 500 measured in dollars. Looks great, right? all-time highs. Your 401k looks amazing. But the orange line is the S&P 500 measured in gold, meaning how many ounces of gold would your stock portfolio actually buy you? And that line is going down. In 2025, gold returned 66%. The S&P 500 returned 17.78%. Gold is not going up because gold is suddenly amazing. Gold is going up because the dollar is going down. Your purchasing power, what your money can actually buy, is shrinking quietly in real time. That is the crash. It's just wearing a disguise. Okay, so what do you actually do with this? Because I don't want this to be a doom and gloom video where I scare you and then leave you hanging. Let's talk about 3 practical moves. Move 1, get some gold exposure. I'm not saying go full prepper and bury gold coins in your backyard. I'm saying look at your portfolio and ask, do I have any allocation to gold? Most financial advisors, Sprott, the World Gold Council, USA Gold, recommend somewhere between 5% and 15% of your portfolio in gold or gold-related assets. JP Morgan is forecasting gold at $6,000 per ounce by Q4 2026, and they're not a fringe operation. That's the biggest bank in America. VanEck's data shows gold has delivered roughly 65% annualized returns over the past year versus about 17% for US stocks. This doesn't mean timing the market. It means having a position before everybody else figures out what's happening. The World Gold Council just released their 2026 strategic asset report confirming gold's role as a long-term portfolio anchor, not a trade, an anchor. Move 2, understand Bitcoin, but go in with your eyes open. Bitcoin has a fixed supply of 21 million coins. That's it, ever. In a world where governments are printing currency endlessly, a truly scarce asset has obvious appeal as a long-term store of value. Wisdom Tree's Hard Money Renaissance report makes a compelling case for holding both gold and Bitcoin as complementary hedges in a sovereign debt environment. But, and this is a real but, Bloomberg just reported this month that Bitcoin has fallen 36% over the past year and slipped below $70,000. Its inflation hedging promise is getting challenged hard right now. Bitcoin still behaves more like a risk asset than a safe haven in most market conditions. If the market sells off, Bitcoin usually sells off harder. So here's my honest take. Bitcoin is interesting and worth a small allocation for the right person, but it is not a replacement for gold. Not yet. Go in informed, not hype-driven. Move 3, diversify into real assets and stop treating cash as safe. Fidelity, one of the most mainstream conservative financial institutions in the world, explicitly warns in their inflation protection guide, don't get too comfortable in cash. Cash loses purchasing power in an inflationary environment. Sitting in a savings account earning 4% while inflation runs hotter than that means you are losing ground every single month. Real assets, commodities, real estate, REITs, energy, have historically held their value during inflationary periods because they're priced in things that people actually need: oil, food, shelter. Fidelity specifically recommends adding commodities to a diversified portfolio as an inflation buffer. Now, Schwab's recession playbook will tell you to stay the course, dollar cost average, and don't panic. And honestly, for the average person, that's not terrible advice. The worst thing you can do is make emotional, reactive decisions. But stay the course only works if the course you're on accounts for purchasing power erosion. Blindly holding a 100% stock portfolio denominated in dollars while the dollar loses value is not a plan. It's just a habit. All right, let's bring it home. 4 floors. .com risk moved to housing. Housing risk moved to the banks. Banking risk moved to the sovereign government. And now sovereign risk is landing on the currency itself. There's no 5th floor. This one doesn't get pushed upstairs. It gets printed away. And you feel it every time you go grocery shopping, fill up your tank, or look at what you can actually afford. The crash isn't coming. It's already here. It's just not showing up in the way you were taught to expect it. The S&P 500 going up while your purchasing power goes down is the crash, and the people who figure that out before the majority do, those are the people who end up on the right side of this. Change the measuring stick. Stop measuring your wealth purely in dollars. Start asking, how much gold does my portfolio buy? How many barrels of oil? What can I actually purchase with what I've saved? Because when you change the measuring stick, you see the world completely differently. And that's where the real opportunity is. If this was useful, drop a comment below and let me know what part hit different for you. And subscribe if you want to keep seeing content like this. We go deep on the stuff the mainstream doesn't talk about. As always, to your success. I'll see you in the next one.